Hey everyone, it's Kenji here from YouTube channel Kenji Explains, and I've partnered with Money Under 30 to create a series of videos. This one's going to be on investing strategies for stock market. So I'll break the video down into four main parts. Firstly, we'll look at how to determine your investment strategy. Secondly, we'll define both active and passive strategies, which are two of the most common ones. Thirdly, we'll go over some of the most common active strategies. And lastly, we'll look at some of the most common passive strategies. So let's get into it. The first step is to determine what you're looking for, and that's usually going to depend on two things: your risk tolerance and your goals. As you can imagine, somebody that's 60 years old and is about to retire in a few years is going to have a very different plan to somebody that's say 30 and expects to be getting a lot of paychecks, hopefully, for decades to come. So when looking at the risk tolerance side, there's what's known as the risk-return trade-off, and generally speaking, the higher the risk, the higher the expected return. When put on a graph, it looks something like this. On the y-axis, you have the expected return, while on the x-axis, you have the risk. Now, if you have a low risk strategy, you can expect low returns. For example, if you leave your money in a savings account that has very little to no risk at all, you can expect to get very low returns. In developed nations, that's usually less than 1%. On the flip side, if you invest in something extremely high risk, like what could be the venture capital space, so investing in startups, if you invested in Facebook in the early days, then you probably made a very handsome return, but for the most part, you're more likely to lose money. The other part of this are your goals and your time horizon. Simply put, the sooner that you need the money, the more conservatively that you should invest it. A general rule of thumb is that if you need it within 5 years, you should invest it conservatively, and some even argue you shouldn't invest it in the stock market at all. So knowing your risk appetite and your goals is going to help you stay disciplined. And these are going to vary by person to person. For example, even with people in the same age group, if your friend works as a freelancer while you work as a full-time employee, that's obviously going to differ because he has a variable salary while you have a fixed one, meaning that you can probably be a bit more aggressive with your investments than your friend. So moving on to the investment strategies, and they're generally split into active and passive strategies. Active strategies are used by those that want to outperform the market. And you might wonder, what do you mean by outperforming the market? Well, there's what's known as market benchmarks that if you do better than those, that means that you're outperforming them. Among the most common benchmarks is the S&P 500 market index, for example. So if you had a 15% return in a given year, while the S&P 500 had a 12% return, then you quote-unquote beat the market. So an active strategy aims to do better than the market benchmark, either by you picking individual stocks or alternatively by investing in a mutual fund, which is a professionally managed fund that invests money for you with a set objective, like what could be trying to achieve above market returns. Now that's just one example of the things that they do. Mutual funds do a lot more other things as well. On the other hand, there's passive strategies, and these aren't trying to beat the market or outperform it. Instead, they're trying to replicate their performance, so essentially get the same return as the market does. That's why they're known as passive. So if the benchmark is the S&P 500 market index and it's up 5%, a passive strategy would also be up that same 5%. And the same goes when the market is 5% down, obviously. And you might wonder, why would you go for a passive strategy when you can go for an active one and potentially do better than the market? Well, the reason is that it's potential. It doesn't necessarily guarantee that it will do better in the market. It's just saying that it will attempt to do so. So if you invest stocks individually, obviously your goal is going to be to do better than the market. And same goes for a mutual fund, but that doesn't guarantee that they will. So sometimes, even if the goal is to outperform the market, you actually end up underperforming the market, meaning that you would have been better off just investing in a passive strategy. As you can imagine, active strategies are generally regarded as more risky. Also, it's worth noting that the expenses, so the fees, are usually higher for active strategies versus passive ones. That's mainly why passive strategies have been on the rise lately, as they're very easy, very inexpensive, and so they're very convenient for the average investor. So now that we understand active and passive strategies, let's look into some common active strategies. And we'll look at three main ones: value investing, growth investing, and income investing. So firstly, value investing, and this is about buying shares that are discounted. In finance terms, that's known as trading at less than its intrinsic value. And you might wonder, what is intrinsic value? In short, very simply put, intrinsic value is just the stock's worth. Now that's not always the same as the current share price. That's because a share might be overvalued or it might be undervalued relative to its true worth. And to calculate the so-called intrinsic value, investors usually have complex financial models looking at things like how the company is going to perform in the future, what its cash flows are going to look like, and so on. Overall, if the intrinsic value of a share is more than the current share price, that means that the stock is worth buying because it's bound to eventually reach the intrinsic value or the true worth. And reasons companies may be undervalued has to do with public perception. Maybe a company's missed its revenue targets, maybe it's being hit by some legal trouble, and so on. Those are reasons that people might get emotional and sell their shares. As a result, that share price could be undervalued. Overall, value investing requires a lot of research to be able to determine an accurate intrinsic value for a company, which is not an easy thing to do. This approach is generally regarded as long-term, lasting quite a few years or even a few decades. The second approach is growth investing, and as the name suggests, this is about investing in companies that have high potential. And they don't just look at individual companies, but they also look at industries on the whole. So for example, if they see that fintech, short for financial technology, is really a booming industry at the moment with a lot of momentum, they might invest in some companies in that space, like say Square or Coinbase. Similarly, if they see that the electric vehicle market is really the future and it's really growing, they could invest in Tesla or Rivian too. When looking at the financial statements of growth companies, they're usually not profitable, and that's because they're prioritizing growth. If we take the case of Rivian, for example, they're currently trading at around 90 billion as their market capitalization, so their market value, and yet they've still to make a profit. Overall, growth investors tend to own stocks for just a few years, and that's because companies tend to grow more slowly or even stagnate as they become larger. The third approach is income investing, sometimes referred to as dividend investing. And the idea here is that by buying shares that pay you a dividend, meaning that they distribute a portion of their profits, you're able to quote unquote earn an income of that. For example, Apple, one of the world's most valuable companies, distributes cash dividends of 22 cents per share each quarter. And that share price is currently around $170, so that means that you need to buy a ton of shares for this to be significant for you. That's why it usually makes sense for people that are about to retire or already retired, that they've saved up a lot of money from say 30, 40 years of working, and now they have all this money that they want to invest and get dividends off that. Income investing investors usually target companies that are already established and they're not very volatile, so the share price doesn't fluctuate up and down too much. That's mainly because they're going to be able to pay that dividend payment. This is regarded as a conservative strategy, that's why it makes sense for retired people, as they aren't necessarily earning a salary anymore, and so they don't want to risk losing their investments. When it comes to passive strategies, it's primarily about index fund investing. And like we mentioned earlier, this is about trying to replicate the performance of a market, not necessarily to beat it. And the idea here is to be there for the long run, so a buy and hold strategy as they call it. This approach is usually done by investing in an index fund like Vanguard's 500, which replicates the performance of the S&P 500. As you can see from this table over here, the average annual returns over a 10-year period have pretty much been the same. The only main difference there between the two usually has to do with fees. So the goal here is not to hop on the latest electric vehicle trend or try to time the market such that you sell your stock just before it crashes, but rather it's to trust that in the long run, the market is going to have generally positive returns. And here's a chart showing how the S&P 500 index has performed over the last 30 years. As you can see, the general trend has clearly been upwards, with an average return of around 12%. There has been a few notable drops, like in 2008 during the financial crisis, or even earlier in 2002 during the dot-com bubble. But in the long run, at least so far, it's only gone up. So for passive investors using index funds, it's about not taking on any additional risk, paying very little fees that are usually less than 0.1%, and staying invested for the medium to long run, so a few years all the way to a few decades. Those are the main active and passive strategies, but do keep in mind that they're not exclusive. For example, it is quite common to have a large portion of your investments, so of your portfolio, put into a passive strategy, while having a smaller portion into an active, more aggressive strategy as well. Similarly, it is quite common for your risk profile to change over time or your goals to change over time. For example, maybe you've just had a kid or maybe you've just bought a house. Things like that will obviously make you change your mind when it comes to your investing decisions. That said, if you change investing strategies too much, that's only going to lead to paying a lot more in fees and also having to pay capital gains tax on some of your investments. So make sure you do that wisely. Although we've looked at some of the most common strategies, there's plenty of other ones out there as well. For example, there's technical analysis, also known as momentum investing. Now, these investors look at complex charts and data to try to predict future patterns in share price movements and as a result try to profit off them. Another one that's recently been getting a lot of attention is impact investing, also known as sustainable investing, which kind of as the name suggests, this is about investing in companies that are positive for the environment and for the planet. So investors will invest in companies that are using renewable energy, that are trying to fight pollution, or recycle materials. Similarly, investors would try to avoid companies in the tobacco space, in the gambling space, or oil and gas as well. Lastly, what we've covered in this video has to do with the stock market, but it is sensible to try to diversify, so essentially not put all your eggs in one basket. For example, if you have enough money saved up, you can consider investing in the bond market or in the real estate market as well. That's all for this video. I hope you found it useful. If you did, feel free to check out my other videos on my YouTube channel at Kenji Explains. That's all for this one, and I'll see you in the next one.